we haven't had this high of a probability of being in a recession that without actually entering one in the past few years. And if we see big spikes in the unemployment rate, that brings faster, bigger cuts into the agenda. Markets still not pricing the end point of the cutting cycle.
Welcome to Wealthion. I'm your host, Andrew Brill. With news of a rate cut on the horizon, we now get earnings from Nvidia this week, and we'll discuss what is expected from that coming up next. I'd like to welcome back Dylan Smith to Wealthion. Dylan's the Vice President and Senior Economist at Rosenberg Research. He also has a weekly podcast that sums up the week's economic activity. We'll tell you about that later. Dylan, welcome back to Wealthion. Always a pleasure to have you.
Thanks very much for having me on again, Andrew. Always my favorite not my own podcast appearance.
So let me ask you, an exciting week last week. Chairman Powell did what he had to do, or said what we thought he had to say. And what do you feel is the current state of the economy?
Yeah, I think what Powell did really was to lock in what the base case expectation was from markets. So I think he took out a lot of tail risk that people still had priced here and there, and has entrenched a fair amount of certainty, at least on how the Fed's looking at the economy and what that means for the rate outlook, at least as much as he can in one speech or one event. So the state of the economy, look, I think Powell was right to diagnose, maybe a little later than we would have liked, but nonetheless he's got there, which is the labor market having pretty much fully normalized back to where it was going into the beginning of COVID-19. And remember that at that point, we were on a rate reduction path. I think, there were three rate cuts even before COVID hit. And we were on our way down to, we thought at that time, a rate of about 150. The neutral rate estimate is only slightly above that now at 175. And so, based on similar looking labor markets and actually similar levels of, underlying momentum slowing a little bit, slack emerging in the economy, after a 5-year round trip, we're almost in the same place we were then, except with the big difference of a lot further to go in terms of rate cuts. So everyone's gotten behind the September cut, whether it's 25 or 50 basis points, is more of a signaling mechanism for the Fed right now. We think there's a strong case for them to use that to show, look, this is going to be a fairly aggressive cycle. We want to get to neutral. I think that's what 50 would say. And I think there'd be more easing priced in earlier if they were to do that, versus 25, which is probably should be the base case, and which is the base case of, don't get ahead of yourselves. We're going to ease it down. And I think the fact that the speech didn't give much guidance on the pace of cuts, just the need for some of the restrictiveness to come off based on what's happening in the labor market is indicative of what's going to happen in September. Now, as to the state of the rest of the economy, we think that labor market easing can happen quite rapidly now. And actually, the paper or the presentation that followed just after Powell was probably the most interesting thing that happened at Jackson Hole. This was a little bit underreported, but it's given the sort of intellectual framework for what the Fed is looking at now, which is a much stricter focus on the labor market, essentially telling us inflation upside risks have dissipated. We're confident we're back on a trajectory to 2%. Let's look at the labor market. And the sort of fashionable way to look at the labor market these days is not just unemployment, but the ratio of unemployment to firm vacancies. So who's looking for jobs and what's the sort of availability of jobs, that they can move into. And that gives you a sense of how tight the labor market is. Now, what this paper basically said is that when you have an extremely tight labor market, the sort of situation we were on post-COVID, where part of the labor force was still excluded, people were switching industries, the need for labor was very different across industries than what we typically would have in a normal economy. Initially, much more requirements in the goods economy, and then once that stabilized, the services economy found itself short workers. So those very tight labor markets, when you're in that situation, one thing you get is highly amplified shocks. And so if you have a supply chain issue, if you have a sudden increase in demand, say that happens when you have a stimulus check suddenly land in everyone's inbox, you get much more inflationary pressure than you would in a normal labor market. So that was finding one, and that there's a lot of retrospective here. We could have had that information at the time, and that's what kind of the very clearly transitory talk from the Fed, kind of markets didn't believe at that time for a reason. But what you also get is the adjustment back to a normal labor market happens through vacancies, not through the unemployment rate. And that's sort of how you know that you're in an unusual labor market where the unemployment rate is staying very, very low, but firm vacancies are dropping. And that's exactly what we've been seeing until about 5, 6 months ago. And I think we were talking at that time, and we were saying, look, vacancies have come down. We didn't have quite the same language for it as the paper used, but we're going to see the unemployment rate start to rise now, and that is exactly what has happened. And now that we're sort of in this more normal situation, we think that can happen actually quite quickly. And so that's what the pace of rate cuts is going to be pinned on. Markets still not pricing the end point of the cutting cycle, being around neutral within a year or so. And we think that's where the risks are tilted towards a faster and more aggressive easing, even without an official recession, than should be the case. And those recession risks, by the way, are still quite high. So that's kind of where I'll leave it on the overall state of the economy summary.
I have a question about vacancy rate. Do you think the companies are just tightening their belts, not filling vacancies? In other words, if they have, let's say, 5 slots, they're saying, okay, you know what, we'll go down to 4 slots or even 3, and maybe have someone job share. So they may not have laid people off, but they're not filling a vacancy that they may have had. They may have just said, okay, you know what, we're going to do away with that job and have fewer people working here.
That's exactly right. We would completely agree with that. I think the process that firms have largely been following, if you take it from the point where labor markets were extremely tight and all the companies had these job ads posted, there was a fierce war for talent at that time, right? We saw job hopping numbers increasing. We saw people getting huge pay bumps for changing jobs. And that caused a little bit of a mindset of labor scarcity among companies. And so there's been a few things happening since then. One is that they're reluctant to trim down the workforce, having just made all those hires. And so the adjustment, as you're saying, has been fairly organic, right? Companies have been very happy to let people leave on their own. We see this in being reported all over the place, especially in services industries where the big 4 accountants or the consulting companies have all been in the news for wanting to get their labor force trimmed down, but they're doing it by sort of, putting people on a review and almost sort of waiting for them to leave organically and find something better. They're not taking the sort of mass layoff approach that, say, the more flexible tech industry was able to take quite early. Outside of the tech industry, it's all been, let's wait and see, but in the meantime, we'll take down those job posts. And I think we're now entering a phase where the companies who are seeing, demand looking a bit tight, they're losing pricing power, margins are getting squeezed. That's when you see the layoffs start to happen. And so that's, on a 1-year outlook, we think that's a much more likely scenario than it's been for the last year or so.
So the layoffs might still be coming, you think, from judging from your research?
Exactly. You start off by taking the job posts down, then you take hours down, and we've seen total hours falling and hours per worker falling. You let those part-time contracts kind of slip away. And only then do you take the much more difficult step of actually trimming full-time labor force. So that's still in the pipeline. And we know from prior recessions, the labor market's probably the most lagging element, right? You see all the layoffs happening way after the recession started, right? It's something that companies, don't like to do. It's generally a last resort to do sort of large-scale layoffs or to cut departments or things like that. So, in the meantime, we'll see, and we are seeing efforts to be made to avoid that, especially coming off quite a tight labor market. But that's, if you follow the beverage curve down, that's where we get to.
So you think that there could be a recession, or do you think it's possible to avoid that given what the Fed is about to do?
The Fed will help. They certainly are far tighter than either inflation or the labor market is telling them that they need to be. So, certainly if they weren't easing very soon, we'd be 100% sure a recession's going to start very quickly. Financial conditions are easing, and that provides a bit of a demand stimulus, which is helpful in terms of avoiding a recession. But those risks are all there and very high. You look at the whole swathe of different ways of measuring recession probability. They're all telling you, we haven't had this high of a probability of being in a recession without actually entering one in the past few years. And whether it's a SAM rule type indicator or a labor market thing or a yield curve based one or financial markets, they're all saying, it's kind of 50-50 whether we get into a recession or not. Now, everyone is always focusing on the demand side of the economy when they're thinking about recessions. What's happening with the consumer? Are interest rates sort of hitting firm activity, hitting real activity? But one thing we're seeing this time that's a little different and maybe a little more reminiscent of the early 90s and mid 90s is productivity is growing very rapidly, and the supply side of the economy overall is growing quite rapidly. And so you're seeing high levels of labor force participation and growth in the US economy, and you're seeing productivity improve, partly, as you say, because companies have been forced for a while to work off a smaller labor force than they'd like to. And so what that means is that even as demand tails off, you can have enough supply side growth to help you avoid a recession. Now, that is still highly deflationary or disinflationary, but could be outright deflationary if you combine the fact that you're not going to see much in the way of price increases on the service side of the economy with the fact that the goods sector is still deflating and commodities are down, like 15 to 30% this year. So, all these forces lining up behind the idea that there's probably going to be an undershoot from the Fed that may or may not come with a recession, but all the types of things that outperform in a recession from a market perspective are going to do well. So you're going to see the outlook for bonds very strong. Excess supply conditions mean interest rates should be low. And the sort of open question is what happens on the equity market. Is there a shock that brings valuations down a bit, or can this keep going? That's the thing that's a little less certain in this type of situation where you have supply growth outstripping demand growth without an explicit recession. But as soon as that news starts to happen, as soon as people worry about earnings forecasts being overly optimistic, you can see very quick reversals on that front. So that's something we'd flag as you need to watch out for that.
So is the Fed late? I don't think they're not early, but are they late, or you think they're right on time?
They're probably a little late in our view. And the reason we say that is because it was fairly clear that the labor market was heading in this direction at least 6 months ago. And instead of taking a fairly anticipatory attitude to this, trying to get ahead of the curve and say, we're not there yet, but we can see the situation coming where inflation is settling down and labor markets are going to start to ease. So what we're going to do is take on some excess policy restrictiveness in the knowledge that lags along. This, we're still tighter than we were 3 years ago, 4 years ago. And so now is the time to start trimming. I think a couple of things have spooked them on that front. The first is, they were late in the other direction on the inflation issue. And so, the classic quote that central banks are always fighting the previous battle probably does apply here. The other thing is that, in December, I think it was late November, early December, Powell made a fairly dovish shift. We had a very dovish beige book, and Powell made some comments in that press conference that were more in the dovish direction. And definitely wasn't his intention, but markets went from 2 to 6 cuts priced in really early. Financial conditions eased significantly and almost did the cut for them. And that spooked them. And at the same time, there were some wobbles in the disinflation process. And that all meant that they basically got scared and said, we're just looking at current data. We blinkers on for the future. We'll get to that in Jackson Hole. So, I think that's made them a little late and probably raised the risk that they end up tipping the economy into something of a mild recession versus being able to avoid it earlier on.
How much of a rate cut do you think is necessary? And then I'll follow that up by saying I did listen to your Rosenberg roundup, and there's about 8 cuts, as you said, built in, but wouldn't that depend on the size of the cuts?
Yeah, so that's 8 standard, quote unquote standard 25 basis point cuts within the next year. So almost a one a meeting pace, not quite. How much is appropriate to cut? Well, I think you can get a lot of focus on what's happening at the next meeting, cut or not, or this is important for September because the first cut signals that there's more cuts to come. Generally, it means that we're in the easing cycle unless they do a huge amount of effort to talk their way out of that. which we don't see coming. So the two questions that markets should be asking are how much cutting is required in this cycle in total, and how fast they're going to do it. So question one is fairly easy to answer. They need to at least get to neutral, and they probably need to go a little bit lower based on to counteract some of the lagged effects that are happening, and the fact that once you project that far forward, inflation's below 2%. Right, so you're looking at something like a 2% target rate, maybe a little higher, maybe 25 basis points higher or lower. It doesn't really make much of a difference. The fact is you're coming from from 5.5 down below 2.5, right? Way more than priced in. How fast should they do it? Well, not all in one meeting because everyone will panic. But there's no point doing it too slowly, right? If you're restrictive, you're restrictive, and if the economy is saying neutral is probably appropriate to slightly easy, you might as well set it on a path to get there before it's too slow to do it. So we would say within the next year that should be happening, and that's a little more than markets are priced in. Markets are only about halfway there right now, we would say. The thing we do have some sympathy with is, when you start making larger than 25 basis point cuts, you can cause overreactions in markets. You can cause a little bit of panic by looking a little out of control. That's something the Fed would generally want to avoid, which is why, personally, I think they will do a 25 basis point cut, but they can do a lot by signaling, look, we want to ease a lot. We want to get down to a certain level, or we see this level as appropriate, and we don't see any reason why we would stay much tighter than that for much longer. And the markets will do the rest of the work for you in terms of general financial conditions. You don't need to do those big chunky cuts. But the size of the cut will depend on what markets are doing. If we do see another big pullback from markets, that brings larger cuts onto the agenda. If we see big spikes in the unemployment rate, that brings faster, bigger cuts into the agenda. So the labor market is going to be very, very important, and what's happening generally in equity markets is going to be important too.
So I want to ask you about individuals for a second. We put up a bunch of polls on our YouTube community page, and it seems that most people that answered this poll are just keeping their heads above water. We have some that are struggling, some that say they haven't been effective. That's about 10%, but and some that are doing well. That's also about 10%. But most people are they're getting by, as we say. Is that what you guys are seeing in this economy right now?
It's definitely what the macro data tells you, alongside a bunch of other evidence. I think it's difficult to avoid the fact that the cumulative level of inflation that we've seen over 2 years has been a very sharp shock for a lot of people, and not everyone's wages have kept up. Right, so we are seeing, you can see it in the sort of distributional accounts data you get from the Fed. You see it in earnings reports from places like Target, Walmart, etc., who are saying we're seeing people becoming much more price sensitive. We're seeing them trading down to basics, chicken not pork at the moment. And very interesting, if you add up all the sort of big retailers, the Walmarts, the Targets, etc., their growth, total sales growth for the last year has actually been below inflation. Right? So there's been a real volumes contraction. And that's even with people who would be shopping at the high-end markets, parking their nice cars in a Walmart parking lot now. So that evidence is all there. And the question that emerges, I think, is how come it's not a bigger drop in demand on the macro side? Why isn't that actually recessionary? And there's a few reasons for that. One, as I've been describing, is this big increase in supply. The other is that wages have gradually been catching up to prices as well, so that's been helping. There's still some larger settlements happening, although way lower than we were seeing in the past couple of years, and that process is mostly done. But I think what's informative is that those 10% of people who said they're okay and the 10% who said they're doing well, my guess would be they have a nice savings portfolio. Either they accrued some funds in over COVID, which they've been able to deploy, they made the right bets in Nvidia, whatever. There are certainly wealth effects happening at the economy right now that are very strong. Anyone who's been able to release home equity is in a very strong position. Anyone who's been favorably exposed to the stock market is in a very strong position. And that happens through a variety of different channels. It's general sentiment based. It's the fact people do draw down savings occasionally for large purses. So that's been keeping things ticking along. But it's also why I think the Fed is even more sensitive to the stock market than usual, because it's the main thing keeping people ticking along. And without that force, or if that force starts to reverse, you're going to see a pretty sharp pullback and a very steep dip in sentiment from the consumers who are keeping the economy moving right now.
This show is sponsored by BetterHelp. In these volatile economic times, there may be a lot more on your mind than just what to have for dinner. I'm sure looking at social media and seeing everyone with giant smiles pretending that they don't have a care in the world doesn't really help either. Well, I have a secret for you. They worry about the same things you do. As adults, we take on a lot more of the everyday burden of things and get away from the curiosity that, as kids, we used to explore and learn. It's what made us who we are today, but some of us have lost that curiosity and the desire to forge ahead. I know I did at one point. It's why I turned to therapy to get back on the right track and turn back down the right road to happiness and success. If you need to talk to a professional or are thinking about giving therapy a try, give BetterHelp a try. It's easy, online, convenient, and flexible to fit your schedule. Just fill out the questionnaire and get matched to a licensed therapist anytime. Rediscover your curiosity with BetterHelp. Visit betterhelp.com/Wealthion today to get 10% off your first month. That's BetterHelp, HELP.com/Wealthion. Dylan, about 6 months ago, we saw that wages were actually increasing. The labor force and wages were. Are you still seeing that? Are wages still increasing?
Wages are still rising, somewhere just under 4% a year in nominal terms. So that's about a percentage point higher than inflation is growing. So there is some aggregate gradual real income catch up happening still to the higher price level. We're at about the point now where, at the aggregate level, people are sort of pari passu with where they started before the big inflationary surge. But it's obviously taken a while for wages to catch up. Obviously, those settlements happen a lot more slowly. The space for that to happen is reducing, right? Firms are seeing their pricing power diminish. Kamala Harris's work is going to be done for her by the time she gets into office, if she does get into office. She is correct that a lot of companies, and especially grocery companies, did not reduce prices once costs started to go down again, but now they are. Competition is doing what it's supposed to do. Consumers are pulling back. They are not tolerating any more price increases. They are asking for prices to go down, and that competitive forces are starting to make that happen. You only need to look at McDonald's new pricing strategy from a few months ago to see that in action. So firms are aware that their ability to create margins is going to depend on their ability to manage costs going forward, rather than just purely looking for price advantages in the market. And that's going to put pressure on wages, especially in light of the fact that there has been a catch up in real wage terms.
So consumers are actually doing their job in forcing prices down themselves and creating that competition. So that's actually a really good thing.
Mm-hmm. Yeah, it's starting to happen. There's enough competition in the market to drive that process.
So a lot of our viewers look for long-term wealth, and they're looking for obviously saving for later on. But Dylan, a couple Mondays ago, we had a downturn, I guess you call it, in the market. A bad day. We'll just chalk it up to a bad day. But it's all turned around again, and everything is back up higher than it was. Are we expecting more days like this, or could there be a market correction at some point?
Well, I think what this event shows us is that, as you'd expect from a market with very stretched valuations, forward price earnings over 22 on the S&P 500. We're calling that being priced for perfection, right? And so as soon as something imperfect happens, you can get very large responses. So in this case, it was an unexpectedly hawkish BOJ. It started a bit of an unwind on the enormous yen carry trade that has been quietly building up in the background. That led to all sorts of covering. It hit stocks. It hit tech stocks particularly hard, and people started thinking, like, have we overdone a little bit here? Have we been too optimistic? But what I think is really fascinating about this whole episode is the pattern of the reversal that we've seen. Because we haven't, in price terms, we're sort of back to where we were, right? I think compared to the day before this all happened, the S&P 500 is up about 1.3%. It's very easy to say, well, we had a wobble and everyone actually doubled down and recommitted and we're back to where we were. But I think that actually is slightly the wrong interpretation, because if you look at the cross asset picture, there have been a lot of changes. And the most important and revealing one is that we've seen Treasury yields way lower over that period. So the Treasury market did not round trip. We've actually seen all of those gains pretty much being held on to. I think the 10 years 150 beeps down from where we started before that episode. True, it sort of was 100 lower at one point, but that's revealing. Gold is up. Gold goes up when interest rates go down or interest rate expectations go down, so that's interesting. And general commodities are kind of flat and having a bad year otherwise. So there's been a change in the relative value of assets. And although equities look like they are where they were, compared to treasuries and gold, they're cheaper, right? And the one sort of unifying theory of why that could all have happened is that we have seen interest rate expectations really decline over that period, and that's what's driven the recovery. So there's two things that should drive stock valuations: future expected earnings and the discount rate you apply to that. Now, expected earnings may actually have gone down a little bit since that episode, but the work of the lower discount rate is actually offsetting that right now. So this is all an interest rate story, and it's come at a very good time in terms of where that little panic was, and where the Fed making it very clear that interest rates are going to come down, and sort of a lot of economic indicators, especially from the labor market, saying that needs to happen. That's all flowed into the price.
With rates coming down, is this the last time that we could see treasury rates where they are, or is this a good time to get into treasuries? Obviously, the government has to pay their debts, so they're going to sell treasuries. Is this the last best time to get in, I guess?
That's probably right. Yeah. We've been liking the 10-year for a long time. We saw a lot of good buying opportunities when it was trading, above 420, 425. It's now, just below 4%. We see it going down to, below 3.5 as the easing happens and as the yield curve normalizes. So, and given what you get in terms of duration effects and so on, it's still very appealing. We would say that buying on treasuries is still a very strong strategy. And the second part of that is it can go even lower because treasury demand has been over subdued. Portfolios are under allocated to fixed income and to treasuries, and so beyond just the pure mechanical effects of Fed easing dragging 10-year T rates down, there should be a demand resurgence as well as portfolios start to rebalance. Same goes for gold as well. So yeah, we would still be buyers for sure. But some of the move has been missed. So the next time you get a more hawkish macro print, that we would say probably is going to open up some buying windows.
With the market as inflated as it is, and people worry about their long-term wealth, obviously long-term wealth, you hold on to it, you don't worry about it, you just sit with it. It's going to turn around again. It could come down for a year, maybe two, but if you're in it for the long term, doesn't matter. But if you're looking at people from at retirement age or almost at retirement age, is it time to get some money out of the market? Take your profits and maybe put it into something that, it's not going to grow as fast, or the interest rate, like in treasuries, is not as good, but it's a little bit safer.
Yeah, I mean, I think if your main goal, and this is sort of evergreen wisdom, if your main goal is income from your portfolio and wealth preservation, you want to curtail your exposure to the riskier asset classes, right? So, anyone who's, and it's interesting, older Americans and older Canadians too are at historic levels of proportional investment in equities, right? It used to be the almost default that you would get out of equities the day you retired. That's not happening anymore, and so there's a buildup of risk for the boomers who are quite highly exposed basically to the AI theme, and so if Warren Buffett, boomer number one, is taking profits, I think that says something to that generation. It's time to, and there's kind of a golden opportunity at the moment, because if you move into rates now, you can still lock in pretty high interest rates through various different mechanisms, right? So before the base rate shifts on down to 2%, sub 2%, you can get very good, just fixed income generation, very low risk. There's almost a golden window for that opening up. And so that would definitely be our advice. Now, more interesting question: what happens if you're still in a growth phase? You want to build some portfolio wealth. Maybe you have some cash to deploy, but you're looking at valuations and saying, well, if I go in now, I'm going in at a bit of a peak potentially. Well, there's cross-asset ways to fix that. So just make sure you're very diversified. Follow the old wisdom and rules about not overexposing to the riskier side of the asset class. Probably overweight the fixed income complex at the moment. And keep your sector allocation sensible, right? You should definitely have some tech exposure. There's still a potentially massive AI story out there, but don't go all in on that. Utilities are great. Utilities are benefiting from almost every theme out there. So stick to that. There's some real opportunities in real estate outside the commercial and office space, which we still really don't like. So trying to find value, trying to wait in a way that is resilient to potential downside and to potential corrections.
And if you're into the commercial real estate, stay away from regional banks because they may get hurt a little bit, right?
Yeah.
I heard that on your podcast, so we'll stay away from regional banks at this point, right?
Yeah, there's been so much going on that everyone's forgotten about that. But that combination of nearly insolvent looking bond portfolios and very high exposure to real estate is not a nice combination for regional banks. There's a reason they're priced where they are.
So I almost had a personal question, but I'm sure some of our viewers will be interested in finding out. With bond rates being right around 4, there are some quality stocks that give dividends. Why not put that don't move a ton? Why not put some of your money there and it's almost like fixed income there as well, isn't it?
Absolutely, yeah. And if you look at our sort of overall recommendations from our different models, that's sort of where we're pushing people. So we like to talk a lot about those recession-proof stocks, things like Walmart, anyone selling necessities, that people have to go to, but where they'll be looking for value, that tends to outperform the rest of the market, and tends to generate very nice dividends as well. Other things we like, utilities are really fascinating right now because the general income structure of utilities is very predictable, very fixed. Take something like a toll road as the key example. People don't really stop driving around much. They have to pay the tolls. You know how much they're going to pay, and it's going to be a sort of fixed yield. And the cost base of that utility will also be very, predictably structured, and so it's very safe, generally quite boring. But what's happening now in utilities is these two big themes. One is AI, and this massive build out of manufacturing capacity, of data centers, of general infrastructure that is meaning that a lot of investment is flowing to utilities, and there are shortages emerging, which means high profit opportunities for utilities. The other is a general, and this is related to AI, but it's broader, a general recognition that there will be a surge in demand for electricity over the next decade or two decades, coming from the general kind of transition technologies emerging, right? So if you switched every car on the road tomorrow to an electric vehicle, well, guess what? You need to power them from the grid. That trend is happening kind of all through the economy, and it means that power and water are basically going into a regime of scarcity, which they haven't been in a long time. And so everything connected to utilities and those two themes is outperforming for a very good reason. And in the meanwhile, it still has predictable dividend flows and limited downside risk. So that's a part of the market we really, really like. And then there's always, other ways to benefit from sort of some of the thematic things emerging. We saw some reporting today on how profitable defense stocks have been of late. We don't think the geopolitical situation is going to get any better anytime soon, and so those remain good buys. We like the gold miners, who we think are undervalued. That's part of our general gold call, but people have been staying away from them because of the cost base. Well, the demand side and the price side is good enough to make those, we think, undervalued at the moment. So there's pockets of outperformance, pockets of value you can have, even when you think the macro picture and the valuations picture is unappealing.
So before I get into the obvious, because Nvidia reports this week, I want to ask you about real estate. Now, with rates coming down, do you think now? And I know that home sales increased in July. So we'll get the August numbers in a couple weeks. But do you expect real estate sales to pick up even more? And I would imagine refinances are going to go into effect, from people who bought in the
Yeah.
last couple years.
Yeah. So this is another big and important effect of rate cuts, and another reason we say they're going to move as far as they have, or as far as they will rather, back towards neutral, right? If you look at housing affordability, it's at its most stretched level pretty much ever. That's a combination of very high interest rates, so expensive mortgages, and the fact that prices have actually been very high. Reason being that everyone who mortgaged out for 30 years 4 years ago and is paying a 3% fixed mortgage rate, they can't move, right? So supply has actually been highly constrained. It's been mostly limited to new builds, and that has really pushed affordability. Now, to get affordability back down again, the easiest thing to do is reduce all those interest rates and get mortgage rates down. And if you get a sort of 300 basis point reduction in mortgage rates, you start to get to affordability levels that are much easier. That in turn makes real estate a lot more appealing in our view, and sort of unsticks some of the markets that are very sticky, because it unleashes all this demand back onto the market that's been constrained out by lack of affordability. Point is, you have to get all the way down there for that to happen. The Fed will be pushing on a string for its first few rate cuts because it's still at such stretch levels that you won't get an effect for a while. So that's a theme that's emerging and that we like, but it takes a little while to get there. In the commercial space, I think it's still a very bifurcated market. I think we can all ring the bell on work from home being having settled into a sort of pattern, which is essentially partial hybrid, 3 days a week, whatever you want to call it, being the norm, and general demand for office space just being a lot lower. So that is unavoidable, and I think that the market is busy readjusting to that. Part of the effect is that the better you're building, the higher quality, the greener the building, the more appealing and in demand it is. But it's really the lower ends of the office and commercial market that are in genuine trouble, and we don't see interest rates doing a heck of a lot to fix that, because that's not the main issue there. What it will help do is push the sort of related markets around retrofitting, making buildings cleaner, greener. That part of the market we like when interest rates are low, because those investments can be made. And in fact, to be competitive in commercial real estate, you have to make those investments. So that's going to start picking up a little bit on the periphery of that sector. But there's still a bit of cleaning up that needs to be done in the rest of the market, which we would avoid.
With interest rates coming down, Dylan, you would expect home prices to go up. Right now, the median home prices I was reading is about 400,000, and if it goes up from there, it's going to price some people out of the market, even though a mortgage will be a little bit cheaper. And even with candidate Harris's, $25,000 for a first-time home buyer, that doesn't cover the 10% down payment. So at some point, that bubble has to burst, right?
It doesn't cover it, and this is the thing that makes economists really annoyed about politicians is when they don't think in equilibrium terms or in general equilibrium terms. The mistake in thinking that's happening there, and it's not just Harris. The Trudeau government's doing the exact same thing in Canada, which is, if you give everyone their down payment, well, there's still the same housing stock. Prices just go up,
right?
And that does squeeze your affordability. So we don't think that's going to do a lot. If anything, that's going to push prices up. That said, they are trying to put incentives on the other side of the market to bring supply online to try and offset that. But yes, in general, if rates come down, demand does go up, and it's indeterminate mathematically whether or not that pushes prices up. But if you get a one-for-one offset, you're still in the same situation you were in. So as rates come down, as people come back into the market, I think the very important factor is that there is constrained supply that will come back into the market if rates are low enough. So the people who are struggling to afford the 3% mortgage that they locked in whatever, June 2020, currently can't sell because they can't get a similar or lower payment without a massive downside. That house comes on the market once rates are back down at 3%. Right? So it's a very difficult balance to read, and it will probably be pretty choppy in terms of looking at the price data and looking at the sales data. But there is supply coming online. In fact, the multifamily sector is way overbuilt. That's a big downward drag on prices coming. The home builders have been building like absolute crazy.
Yeah.
They're starting to build up extra inventory, and so the supply picture is not looking too bad, even with a pickup in demand, especially if we do get that extra marginal supply coming online as a result. It's a strange and distorted market that needs to rebalance a little bit.
But as more comes online, I guess competition is will do what it does, and hopefully bring some prices down to
Mm-hmm.
affordable levels again, which is what we're looking for.
Yeah.
So let's talk about the elephant in the room. The 28th is when Nvidia reports earnings. Any expectations, Dylan? Because there's a lot of people that are anticipating this, but are there any expectations?
Yeah, look, we don't have a strong view on whether we're going to see missile beat, but obviously that's the big sort of fulcrum that the market's going to move on this week. People like to point out, the 1 cent Cisco miss in the '90s that triggered a crash, and I think Nvidia is starting to be priced in the same direction, right? I think there just is an expectation that whatever the analyst consensus is, because of recent patterns, markets are going to be expecting a beat. And so if we get something that's not an exciting beat, any news of the order book starting to be sort of tailed off a little bit, any news around just issues around production and so on, like the market's very, very, very sensitive to a downside miss. And so it's going to move a lot if that does happen. But it's one of the best companies out there, despite its valuation stretch. It's managed to capture the entire AI narrative, and it has phenomenal competitive advantage in that market. So it is something of a unique company.
Is AI still the rage? From all the research that you do and the people you talk to, or is it the tentacles that AI has created? Like you said before, because of AI, we're going to need new power centers. We're going to need new data centers. Is AI still the rage, or is it the tentacles that it has created that has brought us to where we are?
Well, it's interesting. I think we're reaching an important point, because basically the AI theme has been expressed so far as a hardware play, as a physical play. So that's why Nvidia is has done so incredibly well. They're providing the chips that should power this revolution. Um, those chips demand power. Utilities are outperforming. Um, it is still an open question, and still I think deserves to be treated with some skepticism. What the value creation is that comes afterwards, right? So we know what AI can do, but it hasn't seemed to have developed much since GPT came out, right? There's been some efficiency, there's been some marginal improvements, people have started implementing it, but we haven't seen the Google emerge yet, right? We haven't seen the company that defines what this thing is and how to make it extremely valuable and completely monetized. Um, and we don't know. It's a fact that we don't know. No one in 1997 was predicting the existence of Facebook. There was no concept of a social network. We all thought the internet was about other stuff at that point. Amazon was predicted, right? So maybe you can say that the way Microsoft plans to use AI is a bit more predictable and a bit more priced. But as to whether we'll see a huge revolution in economic productivity, whether we see enormous new world-beating companies emerging, maybe not. But we're certainly acting like that's not going to happen. So there is potential for oversupply of the hardware to happen. There is potential for us to be pricing the value in the wrong area. And so, yes, the theme's all the rage, but I think we're starting to see the theme coming into question a little bit in terms of how it gets expressed and how it gets played.
All right, so you have these massively powerful chips that are the size of your thumbnail, but what you do with them is still the question. So the programmers have to get with the program and make them work, so to speak, and use
Yeah, the
them.
programmers who don't get replaced by AI,
Exactly.
because that's actually the best use case that we've seen, and the reason that tech stocks have performed a lot, and the reason that we're seeing the theme most obviously expressed, even outside of the chip makers in the tech industry, is well, we know this thing can program, it can do language, and it can do well structured programming languages best. So those are people who need to be worried first. As for the rest, I'm not so sure.
So
We'll
let's.
see.
You touched on it earlier. Commodities, gold has gone crazy. The commodities market has not done well. Oil was up a little bit because of the unrest in the Middle East, from 75 to about $80. That's still relatively low from what we've seen it in economic times that have uh, troubled us. So where is commodities? Is that at a low now? People are like, oh, buy low, sell high. Are commodities at a low now? Is this something that we should be really taking a look at?
Depends on the commodity, which I know is not the answer that you wanted. But the distinction we've been drawing is essentially between kind of old economy commodities and new economy commodities, and it's really China exposure that's critical here. Things like iron and steel have been really driven by enormous construction levels in China, and that's really, really tailing off as that whole sort of sector of the Chinese economy works its way out of basically a debt deleveraging cycle. So a huge source of demand has been removed from the market for those types of commodities. And that's why you're seeing copper pretty weak, iron ore pretty weak, those types of industrial materials. Meanwhile, you're also seeing things like the automotive industry going through a little bit of a pullback, and so that's trailing on to demand for everything from sort of steel to platinum as well. That's a little more cyclical. And I think that's where you could make the argument of we're in a bit of a dip there, but it's going to come out again. Where we remain very bullish is on the green commodities. There's the EV narrative is coming into question a little bit, but markets are enormous in China. And we're in a bit of a sort of excess supply area in terms of how much EVs have been built at sort of current technological state, given where demand is. But that technology will improve, and we still think that that transition is, most cars will eventually end up being EVs, and those cars will need batteries. Meanwhile, commercial battery demand for the clean energy industry, for matching sort of when people use power to when power is produced in terms of solar, wind, etc. As battery technology improves and improves, the related commodities, we think are in a very, very bullish state. So that's the piece of the market where we're suggesting the buys happen, in addition to gold and silver from a precious perspective, which is driven by completely different factors.
Could your outlook on the green market change depending on who wins the presidency, or is it the global green market that you're looking at?
I don't really think so. Partly because of the global green market. In fact, where our outlook would change actually is we would become very, very bullish on oil and natural gas in the event of a Trump win, because he said so explicitly that he wants to deregulate the sector and sort of give it what we would see as almost a last hurrah for the next couple of decades. But in terms of green, no. And actually, the place I'd point out as being like the most interesting case study here is Texas, right? Completely Republican controlled, and yet has made full use of the Biden subsidies, has realized it's in a sunny and sometimes windy place, and has aggressively invested in greening its grid and becoming actually a green energy center very, very quietly, even as most of the debate around the sort of Texas Oil Club is about the oil outlook. It's a very green state, and I think that speaks to how powerful those themes are, how powerful incentives can be, and it's a global theme. And so yeah, we would say that if that all gets repriced on a Harris win, people are missing a trick, and you should probably go in.
Dylan, thanks so much for joining me. I really appreciate it. It's called the Rosenberg Roundup, and you host and sometimes co-host. I know this past week you did it solo, and it's a great listen. You can find it. I would assume anywhere you can find a podcast, you can find the Rosenberg Roundup.
Yep, Apple, Spotify, YouTube, those are the big ones. We're there.
It's a succinct summation of the week that just happened. So it's a great listen. I listen to it and I really enjoy it. Where else can we find you in your research, Dylan?
Well, that's the podcast. The written research is all on the website, rosenbergresearch.com. And we are very generous with our trial. If you sign up, just give us your details. You can get a full month of all of our research for free. So that's market strategy, that's econ, special reports, all of our models and data. You can just find that all on the website, rosenbergresearch.com.
And social media, Twitter?
Twitter, yep. Our Twitter is dominated by Dave. Rosenberg himself. He is unbeatable in terms of Twitter fun. So if you want to see what's going on in terms of Twitter, that's the person to look for. We also have our company profiles on LinkedIn, of course, and I do a fair bit of notification there as well. So that's another place you can find us.
Awesome. Dylan, thanks so much for joining me. I really appreciate it, as always, and great insights. I thank you for joining me.
Thanks, Andrew. Great fun as always.
Thanks so much for watching our discussion here on Wealthion with Dylan Smith. He always has good insights as to where the economy is headed. If you need help being financially resilient, please head over to Wealthion.com. Hit the little button in the top right corner that says Find an Advisor and sign up for a free no-obligation portfolio review. And of course, if you would like and subscribe to the channel and turn on notifications so you know when we post new videos on the Wealthion channel. And please do the social media thing with all the links are below in the description. And if you like this content and are looking for more ways to achieve long-term wealth, watch this video next. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish.